Welcome back to Talk Tickers, where we break down these earnings calls so you don't have to.
Absolutely.
Today we're diving deep into EOG Resources Q4 and full year 2024 performance. And let me tell you, this energy giant, they brought some serious heat this year.
Absolutely. They crushed expectations and delivered a masterclass in operational efficiency and shareholder value creation.
Okay, so before we get into, the nitty-gritty, paint us a picture of EOG's overall performance. What were the headline numbers and what should investors be focusing on?
Well, to put it simply, EOG exceeded expectations on almost every front. They reported strong production numbers, both for oil and overall company output. They kept capital expenditures in check, beating their initial forecasts. And perhaps most impressively, they managed to lower operating costs year over year. All of this translates into record returns for shareholders in the form of dividends and buybacks.
That sounds like a winning combination for investors. Let's break it down, starting with shareholder returns. How much cash did EOG return to shareholders, and what's the strategy behind it?
They returned a record-breaking $5.3 billion to shareholders in 2024. That's a massive number, representing a whopping 98% of their free cash flow. It's clear that EOG is prioritizing returning value to its investors.
Wow, 98%? That's a serious commitment. How do they split those returns between dividends and buybacks?
They increased their regular dividend by a healthy 7%, bringing the annual payout to $3.90 per share. That translates to a yield of almost 3%, which is pretty attractive in today's market. On the buyback front, they repurchased $3.2 billion worth of shares in 2024. This aggressive buyback program has reduced their share count by 5% since 2023. And they're not done yet. They still have $5.8 billion remaining on their buyback authorization.
So they're showering shareholders with cash. But what about their own financial health? Are they stretching themselves too thin?
Not at all. EOG ended 2024 with a rock-solid balance sheet, boasting $7.1 billion in cash. They're targeting a cash and debt range of $5 to $6 billion. This conservative approach gives them ample financial flexibility to navigate the ever-changing energy landscape.
That's reassuring to hear. Now, let's move on to operational excellence. What stood out to you in terms of how EOG is running its business? Are there any specific areas where they're, excelling?
EOG is demonstrating operational excellence across the board. They're prioritizing safety, with a 10% reduction in their workforce total recordable incident rate. They're driving production efficiency with improvements in completion design and artificial lift automation. And they're laser-focused on cost control, achieving a 6% reduction in well costs year over year thanks to extended laterals and their in-house drilling motor program.
So they're extracting more oil and gas while simultaneously lowering costs. That's an impressive feat in an industry known for its high operating expenses. Now let's talk about their marketing strategy. How are they ensuring they get top dollar for their production?
EOG is known for its strategic marketing prowess, and this year is no different. They consistently secure top-tier price realizations, outperforming many of their peers.
Really?
This is partly due to their focus on securing access to premium pricing markets. For example, they recently signed 2 new natural gas agreements. One with Williams for capacity on the Transco pipeline, and another with Vitol that ties their gas prices to either Brent crude oil or U.S. Gulf Coast gas indices. Both of these benchmarks tend to command higher prices than traditional Henry Hub pricing.
That's some savvy marketing, for sure. Yeah. It sounds like they're taking a proactive approach to capturing the best possible prices for their oil and gas. Now, what about investments in infrastructure? Did they make any significant moves in this area?
Yes. They completed 2 key infrastructure projects that will enhance their operational efficiency and access to premium markets. The first is the Verde natural gas pipeline in South Texas. This 36-inch pipeline connects their Dorado gas asset to the high-priced Gulf Coast markets. With a capacity of 1 billion cubic feet of gas per day, expandable to 1.5 billion, it's a game changer for their South Texas operations.
So they're strategically positioning their production near key pipelines and diversifying their marketing approach. That's smart. What was the second infrastructure project they completed?
The second project is the Janus gas processing plant in the heart of the Delaware Basin. This facility, with a capacity of 300 million cubic feet per day, is expected to come online in the first half of this year. It will be connected to the Matterhorn pipeline, further strengthening their access to those lucrative Gulf Coast markets.
It sounds like EOG is firing on all cylinders. They're delivering for shareholders, running a tight ship, and strategically positioning themselves for future growth. Now let's talk about their plans for 2025. What guidance did they provide, and what are the key takeaways for investors?
EOG is sticking to its disciplined capital allocation strategy. They've announced a capital program of $6.2 billion for 2025, which is flat year over year. Their focus remains on generating strong returns rather than chasing aggressive production growth.
So what are their specific growth targets for 2025?
They're targeting 3% growth in oil volume and 6% growth in total production. This indicates a slight shift towards more oil-weighted growth in the coming year, driven by their well mix in the Delaware Basin.
Okay, so measured growth with a focus on oil. Makes sense, given the current market dynamics. Now, before we dive deeper into their specific plans for each of their key plays, let's take a quick detour into the world of hypothetical trading. It's time for our This Is Not Financial Advice segment, where we throw out an outrageous but plausible trade idea inspired by EOG's performance and what they're seeing in the energy market.
All right, let's have some fun. Here's a long-term play that's a bit contrarian. Short oil services ETFs and long EOG.
Okay, that's an interesting one. Why would you pit an oil producer against the very companies that provide the services they need to extract oil?
It all boils down to EOG's relentless focus on in-house capabilities and sustainable cost reduction. They've been investing heavily in building out their own internal service capabilities, like their drilling motor program. This reduces their reliance on third-party oil field service providers. If service cost inflation heats up again, as it often does in cyclical industries, EOG will be less vulnerable. This could give them a significant edge over their peers who are more dependent on those external service providers.
So you're essentially betting on EOG's ability to control costs and navigate a potential service cost crunch better than the broader oil services sector.
Exactly. They're masters of their own destiny.
That's a thought-provoking idea for sure. But remember, folks, this is purely hypothetical and for entertainment purposes only. Don't mistake our wild speculation for actual investment advice. Now, with that disclaimer out of the way, let's get back to EOG's 2025 plans. Let's break down their outlook for each of their key plays, starting with the Delaware Basin. What are they planning for this crucial asset?
They're keeping activity levels flat in the Delaware Basin, but that doesn't mean they're standing still. They're increasing capital efficiency and focusing on longer laterals. They plan to increase average lateral lengths by at least 20%.
Okay, so it's all about doing more with less in the Delaware Basin. Longer laterals mean they can access more oil from each well, which should lead to higher production and lower costs per barrel. What about their other flagship asset, the Eagle Ford? Are they maintaining the same level of activity there?
They're actually slightly moderating activity in the Eagle Ford, but similar to the Delaware Basin, they're also deploying longer laterals. This strategic shift reflects their disciplined approach to capital allocation. They're constantly evaluating returns across their entire portfolio and directing capital to the areas where it will generate the most value.
So even a highly productive asset like the Eagle Ford has to compete for capital with other opportunities.
Absolutely. And in this case, EOG sees greater potential for return on investment in their emerging plays like the Utica and the Dorado, as well as in their international ventures. They're not abandoning the Eagle Ford by any means. They're just being strategic about how they deploy their resources.
That's interesting. It sounds like they're applying a portfolio management approach to their asset base. Now, what about their emerging plays, the Utica in Ohio and the Dorado in South Texas? Are these areas getting more attention?
Absolutely, they are. EOG is clearly excited about the potential of these emerging assets, and they're putting their money where their mouth is. They're increasing activity levels by 20% in both the Utica and the Dorado.
Wow, that's a significant increase. What's driving their optimism about these plays?
In the Utica, they're seeing increasingly compelling economics, driven by lower well costs and improved drilling efficiency. Plus, they have a vast acreage position there, which gives them a lot of running room to scale up their operations. The Dorado is attractive due to its low-cost gas production and proximity to key Gulf Coast markets. They're already producing natural gas from this play, and they see significant potential to ramp up production in the coming years.
So a balanced approach, continuing to milk those cash cows in the Delaware and Eagle Ford while investing strategically in the Utica and Dorado. Now, what about their international ventures? They mentioned some activity in Trinidad and a new joint venture in Bahrain. What's the scoop there?
Their international portfolio is getting a modest boost in capital expenditures this year. In Trinidad, they're planning 4 net wells from their brand new Mento platform and will start building the Coconut platform to support a joint venture and farm-out agreement they signed last year.
Sounds like a busy year in Trinidad. Now, what about Bahrain? What are they up to in that part of the world?
They've partnered with Bapco Energies to explore and develop an onshore, unconventional, tight gas prospect. They're particularly optimistic about applying their expertise in horizontal drilling and completion technology to unlock the potential of this resource. They expect to spud their first, sometime in the second half of this year.
Okay, so they're planting some seeds for future growth internationally. But what's the bigger takeaway for investors? How does all of this tie together in terms of EOG's overall strategy and positioning in the energy market?
EOG is demonstrating its commitment to long-term value creation through a clever blend of disciplined growth, a relentless drive for operational efficiency, and strategic investments in both foundational and emerging assets. They're not just chasing production numbers, they're focused on generating strong returns and lowering their cost structure over time. Their diverse portfolio of assets, both domestically and now internationally, coupled with their rock-solid balance sheet, puts them in a great position to weather any storms in the energy market.
Agreed. They seem to be firing on all cylinders, generating value for shareholders while strategically positioning themselves for the future. Now let's shift gears and delve deeper into their plans for the Utica and Dorado. What are the key details investors should be paying attention to?
In the Utica, they're aiming for 2 full-time drilling rigs and 1 full-time frac fleet by year-end. This will allow them to significantly ramp up activity and production from this promising play.
So they're making a serious commitment to the Utica. What about the Dorado? What are their specific plans there?
They're maintaining 1 full-time drilling rig in the Dorado, which will allow them to steadily increase production from this low-cost gas play.
Okay, so continued steady growth in the Dorado. Now let's switch gears again and dive into another round of our This Is Not Financial Advice segment. What outrageous yet plausible trade idea have you cooked up for us this time?
All right, here's one that's sure to raise some eyebrows. We go long EOG and short one of their Permian Basin peers, like Pioneer Natural Resources.
Okay, that's an interesting pairing. Why this particular matchup?
It's all about contrasting strategies and bets on the future of natural gas. While both companies are top-tier operators in the Permian, Pioneer is making a major push into natural gas production, believing in its long-term potential as a global energy source. EOG, on the other hand, while not abandoning gas, is maintaining a more balanced approach.
So you're essentially betting that EOG's balanced portfolio will outperform Pioneer's more focused gas play.
Exactly. Especially in a world where oil prices remain relatively strong and natural gas faces some headwinds, potentially from new LNG capacity coming online, EOG's diversified approach could prove more resilient.
That's a nuanced trade idea that highlights the importance of understanding a company's strategic direction and how it aligns with broader market trends. But remember, folks, this is purely hypothetical and for entertainment purposes only.
Absolutely. Always do your own research and consult with a professional before making any investment decisions.
Now let's wrap up this segment of our deep dive into EOG Resources. We've covered a lot of ground, but there's still more to explore. Stay tuned for part 2, where we'll delve deeper into EOG's sustainability initiatives, their international expansion, and their unique corporate culture. See you soon.
Welcome back to Talk Tickers. Let's continue our deep dive into EOG Resources.
All right, so we've covered EOG's stellar financial performance and operational excellence. We've also touched on their strategic investments and international expansion. Now let's shift gears and talk about something that's becoming increasingly important for investors: sustainability.
That's a great point. Sustainability is no longer just a nice to have. It's a must have for companies that want to attract and retain investors. And EOG is clearly taking this seriously.
Okay, so what are some of the key initiatives that EOG is undertaking to reduce its environmental footprint?
They're taking a multi-pronged approach, addressing everything from emissions reductions to water conservation and biodiversity protection.
That's encouraging to hear. Can you give us some specific examples of what they're doing in each of those areas?
On the emissions front, they're continuing their efforts to reduce methane leaks, which are a major contributor to greenhouse gas emissions. They're also investing in technologies to capture and store carbon dioxide, preventing it from entering the atmosphere.
So they're taking concrete steps to address climate change. What about water conservation? That's a big issue, especially in water-stressed regions where they operate.
Absolutely. They're implementing advanced water management techniques such as recycling produced water and using brackish water sources whenever possible. This reduces their reliance on fresh water resources and minimizes their impact on local water supplies.
That makes sense. It's all about using water more efficiently and responsibly. Now, what about biodiversity protection? How are they addressing that aspect of sustainability?
They're going beyond simply minimizing surface disturbance. They're actively working to restore habitats, protect sensitive species, and even create wildlife corridors on their properties.
So it's not just about avoiding harm, it's about actively contributing to the health of the ecosystem.
Precisely. They're taking a holistic view of their impact, recognizing that a healthy environment is essential for their long-term success.
It's impressive to see an energy company embracing sustainability with such conviction. They're proving that you can be both profitable and responsible, that economic growth and environmental stewardship can go hand in hand.
I completely agree. Now, let's shift gears again and explore another outrageous but plausible trade idea in our This Is Not Financial Advice segment. This one is for the true energy market mavericks out there.
Bring it on. I'm feeling adventurous.
All right, here's the play. We go long EOG and short the US dollar.
Whoa, now that's a macro play. I can see where you're going with this. A weaker dollar typically benefits commodity prices, including oil and natural gas, right?
You got it. This trade is essentially a leveraged bet on EOG's revenue and earnings, amplified by a potential tailwind from a weakening dollar. If the dollar weakens, EOG's oil and gas production priced in US dollars becomes more attractive to international buyers. This could potentially boost demand and push prices even higher.
So it's a double whammy. EOG benefits from both rising energy prices and a favorable currency exchange rate.
Precisely. But keep in mind, this trade comes with its own set of risks.
Of course, there's no free lunch in the markets.
Right. The dollar's movements are influenced by a myriad of factors, including interest rate differentials, global economic growth, and geopolitical events. Trying to predict the dollar's direction is notoriously difficult, and getting it wrong could wipe out any gains from EOG's operational performance.
That's a crucial point. This is not a trade for the faint of heart, or those with a low tolerance for volatility. Okay, we've had some fun exploring that unconventional trade idea, but let's bring it back down to earth for a moment and talk about what investors should really be focusing on when it comes to EOG and the broader energy sector. What are the key questions they should be asking themselves as they evaluate investment opportunities in this space?
I think the most important question is, how resilient is this company to fluctuations in energy prices? We know that oil and gas are cyclical commodities, prone to booms and busts. Investors need to assess a company's ability to generate free cash flow and maintain a healthy balance sheet even when prices are low. EOG, with its low-cost structure, operational excellence, and disciplined approach to capital allocation, seems well-positioned to navigate these cycles.
Agreed. Beyond financial strength, I think investors should also consider a company's long-term strategy. Is it simply trying to maximize production in the short term? Or is it thinking about the energy transition and how it can adapt to a world that's increasingly focused on decarbonization? EOG, with its investments in renewable natural gas, its focus on reducing emissions, and its exploration of new technologies, seems to be taking a more holistic view of the energy landscape.
Absolutely. And finally, I think investors should pay attention to management's track record and their ability to execute on their strategy. EOG has a long history of disciplined growth, operational excellence, and shareholder-friendly policies. That consistency gives me confidence in their ability to continue delivering value, even amidst uncertainty in the energy market.
Well said. So to recap, investors evaluating energy companies should prioritize financial resilience, a forward-thinking strategy, and a proven management team. EOG seems to check all those boxes, but as always, it's up to each individual investor to do their own research and come to their own conclusions. Now, before we wrap up this deep dive into EOG Resources, I want to circle back to something we touched on earlier, their international expansion.
Ah, yes, their ventures in Trinidad and Bahrain. Definitely a bold move, but one that I think has the potential to pay off big time.
Exactly. Let's start with Trinidad. They've been operating there for over 30 years, so they're not exactly strangers to the region.
Right. They have a deep understanding of the geology, the regulatory environment, and the local workforce. Plus, they've established strong relationships with key partners and stakeholders, which is crucial for success in any international venture.
What's interesting is that they're not just sticking with conventional offshore production in Trinidad, they're also exploring unconventional onshore opportunities, leveraging their expertise in horizontal drilling and fracking to unlock new sources of natural gas.
That's right. They're applying their proven playbook from the U.S. shale revolution to a new frontier.
It's a smart move, especially as global demand for natural gas continues to rise. Now, let's talk about Bahrain. This is a brand new venture for EOG, so there's a bit more uncertainty, but also a lot of excitement.
It's definitely a higher risk, higher reward proposition. They're partnering with Bapco Energies to develop an onshore, unconventional tight gas play, which has already shown promising results from previous exploration efforts.
What has me particularly intrigued is that this venture aligns perfectly with EOG's core strengths.
You're referring to their expertise in unconventional resource development, right?
Exactly. They've proven time and again that they can unlock value from tight formations that were once considered uneconomical.
It's like their superpower. They take on these challenging geological puzzles and crack the code, figuring out how to extract oil and gas efficiently and profitably.
And if they can replicate that success in Bahrain, it could be a game changer for the company, adding a significant new source of production and cash flow to their portfolio.
Plus, it diversifies their geographic footprint and gives them exposure to a new and potentially lucrative market.
Right. It's all about finding those new frontiers, those untapped resources that can fuel future growth. And EOG seems to have a knack for it.
They're like the Lewis and Clark of the energy industry, constantly pushing the boundaries, seeking out new opportunities.
Always exploring. It's in their DNA. Now, let's shift gears one last time and talk about EOG's commitment to sustainability. It's something they emphasize throughout their earnings call, and it's becoming increasingly important for investors, especially those with a long-term perspective. What initiatives stood out to you?
They're really taking a multi-pronged approach, tackling emissions reductions, water conservation, and even biodiversity protection.
Okay, break it down for us. What are they doing specifically to reduce their environmental footprint?
On the emissions front, they're continuing to reduce methane leaks, which is a major contributor to greenhouse gas emissions. They're also investing in technologies to capture and store carbon dioxide, essentially preventing it from entering the atmosphere.
So they're taking concrete steps to minimize their impact on climate change. What about water conservation? That's a big issue, especially in arid regions where they operate.
Absolutely. They're implementing advanced water management techniques such as recycling produced water and using brackish water sources whenever possible to reduce their reliance on freshwater resources.
That makes sense. It's all about using water more efficiently and responsibly. Now, what about biodiversity protection? How are they addressing that aspect of sustainability?
They're going beyond simply minimizing surface disturbance. They're actively working to restore habitats, protect sensitive species, and even create wildlife corridors on their properties.
So it's not just about avoiding harm, it's about actively contributing to the health of the ecosystem.
Exactly. They're taking a holistic view of their impact, recognizing that a healthy environment is essential for their long-term success.
It's refreshing to see an energy company embracing sustainability with such conviction. They're proving that you can be both profitable and responsible, that economic growth and environmental stewardship can go hand in hand. Now, before we dive into our This Is Not Financial Advice segment, I want to address a question that's been on my mind as we've been dissecting EOG's performance. It's about their culture. We often hear companies talk about their unique or innovative cultures, but it often feels like empty jargon. What is it about EOG's culture that seems to drive their success?
It's a great question, and it's something that's hard to quantify, but clearly evident in their results. I think it boils down to a few key elements. First, there's a strong emphasis on decentralization and empowerment. They trust their people in the field to make decisions, to innovate, and to find solutions.
So it's not a top-down command and control environment.
Not at all. They foster a culture of entrepreneurship and accountability. They give their teams the freedom to experiment, to take risks, and to learn from their mistakes.
That's a powerful approach, especially in a dynamic industry like energy, where agility and adaptability are crucial.
Absolutely. And second, there's a deep-seated commitment to continuous improvement. They're constantly seeking ways to do things better, whether it's drilling wells more efficiently, reducing their environmental impact, or developing new technologies.
So they're not resting on their laurels even after a record-breaking year.
Not a chance. They have this relentless drive to innovate and to push the boundaries of what's possible. And finally, I think there's a genuine sense of pride and ownership among EOG's employees. They believe in what they're doing, they're passionate about their work, and they're committed to the company's success.
It's that intangible esprit de corps that can make all the difference. Okay, I'm sold. EOG's culture sounds like a real competitive advantage. Now let's switch gears one last time and have some fun with our This Is Not Financial Advice segment. We've explored some pretty wild trade ideas already, so what do you have up your sleeve to top them all?
All right, this one is for the true energy market contrarians out there. Are you ready to venture into the realm of the truly audacious?
Bring it on, and I'm feeling adventurous.
All right, here's the play. We're going long EOG.
Okay, that's a familiar starting point.
But on the short side, we're going to short the entire electric vehicle industry.
Whoa, now that's a bold statement. You're essentially betting against the future of transportation as envisioned by, well, everyone.
It's definitely a contrarian view, but hear me out. While the electric vehicle hype is reaching a fever pitch, there are some underlying factors that suggest the transition might not be as smooth or as rapid as many predict.
Okay, I'm intrigued. What are those factors?
First, there are still significant challenges with battery technology, particularly when it comes to range, charging time, and cost. Despite recent advancements, electric vehicles still fall short of gasoline-powered vehicles on these key metrics, especially for those who rely on their vehicles for long commutes or frequent travel.
So you're saying that the convenience factor of gasoline cars still reigns supreme for a large segment of the population.
Exactly. And second, the infrastructure needed to support widespread electric vehicle adoption is still lagging. We're talking about charging stations, grid capacity, and even the availability of raw materials needed for battery production.
It's a massive undertaking to transform an entire transportation system that's been built around fossil fuels for over a century.
Absolutely. And third, there are geopolitical and economic risks associated with the supply chains for electric vehicles and their components, particularly batteries. Many of the critical minerals needed for batteries are sourced from countries with unstable political regimes or questionable environmental practices.
So you're raising concerns about potential disruptions to the supply of electric vehicles, which could hinder their adoption and drive up costs.
Precisely. Now, I'm not saying that electric vehicles are doomed to fail. They clearly represent a significant technological advancement, and they'll undoubtedly play a larger role in transportation in the future.
But you're betting that the transition will be slower and bumpier than the current hype suggests, which could benefit traditional oil and gas producers like EOG in the short to medium term.
Exactly. It's a contrarian play, but one that could yield significant returns if those assumptions play out.
Okay, that's a truly bold and thought-provoking trade idea. I love how you connected EOG's performance to a broader macro trend and identified a potential opportunity that most investors are overlooking.
It's all about thinking outside the box and challenging conventional wisdom, right?
Absolutely. Yeah. Now remember, folks, this is pure speculation, not investment advice. Always do your own research and consult with a professional before making any financial decisions. Okay, we've covered a lot of ground in this deep dive into EOG Resources. What are your final takeaways for investors?
I think EOG continues to be a standout performer in the energy sector. They're firing on all cylinders, delivering record shareholder returns, investing strategically in both their core and emerging assets, and expanding their global footprint.
Let's not forget their commitment to sustainability and their unique culture, which seems to empower their employees and drive innovation.
Absolutely. They're a company that's worth watching closely.
I couldn't agree more. So there you have it, folks, a comprehensive look at EOG Resources Q4 and full year 2024 performance. We covered their financial results, operational highlights, strategic investments, and even threw in some wild trade ideas for good measure. Welcome back to Talk Tickers. We're wrapping up our deep dive into EOG Resources Q4 and full year 2024 performance.
They've impressed us with their operational efficiency, their strategic investments, and commitment to sustainability. But there's one more area where they really shine: their natural gas marketing strategy.
You're right. They're not just pumping gas into a pipeline and hoping for the best. They're being very deliberate about how they get their gas to market and secure those premium prices.
Exactly. They've diversified their takeaway options, secured capacity on multiple pipelines, and negotiated contracts that tie their prices to the most favorable benchmarks.
It's all about maximizing value. They're not just price takers, they're price makers.
And they're also thinking ahead, positioning themselves to capitalize on the growth of LNG exports. Their deal with Cheniere for their Corpus Christi Stage 3 project is a prime example.
Yes, they've locked in a 300,000 MMBTU per day sales agreement linked to Henry Hub pricing. This will provide a solid revenue stream as that LNG facility comes online.
It's a strategic move, considering the potential for Henry Hub prices to rise as more LNG export capacity comes online. This will increase demand for U.S. natural gas.
We've covered EOG's financial performance, operational excellence, strategic investments, international expansion, commitment to sustainability, unique culture, and savvy natural gas marketing strategy. Is there anything else we should add to this comprehensive deep dive?
I think we've hit all the key points, but there's one overarching theme that ties it all together: their ability to adapt and evolve.
Tell me more.
They're not stuck in the past clinging to old ways of doing things. They're constantly learning, experimenting, and pushing the boundaries of what's possible in the energy industry.
It's that relentless drive to improve, to innovate, to be better today than they were yesterday.
Exactly. And that mindset, I believe, is what will ultimately drive their long-term success.
Agreed. EOG is a company that's built for the future, a future that will undoubtedly be filled with challenges and opportunities. And now it's time for the grand finale, the culmination of our speculative journey. Our final, this is not financial advice, trade idea. You've saved the wildest one for last, haven't you?
I believe I have. This one is for the true energy market visionaries, those who dare to look beyond the horizon and see the world as it could be, not just as it is.
All right, lay it on us. What's this audacious trade idea?
We're going long EOG.
Okay, that's a familiar starting point.
But on the short side, we're going to short the entire renewable energy sector.
Whoa, now that's a contrarian play and a half. You're betting against solar, wind, geothermal, the whole green energy movement. That's a bold stance to take, especially given the growing momentum behind the transition to cleaner sources of energy.
It is a contrarian view, no doubt, but there are some compelling reasons to believe that the renewable energy revolution might not unfold as smoothly or as rapidly as many predict.
Okay, I'm all ears. Give me those reasons.
First, there are still significant challenges with the intermittency of renewable energy sources like solar and wind. The sun doesn't always shine and the wind doesn't always blow, so we need reliable backup sources of power to fill the gaps. And those backup sources often rely on, well, fossil fuels.
So you're saying that grid reliability remains a major hurdle for widespread renewable energy adoption.
Exactly. And second, the cost of building and maintaining renewable energy infrastructure, particularly large-scale solar and wind farms, is still substantial. While costs have come down in recent years, there are often hidden costs associated with things like transmission lines, land acquisition, and environmental mitigation.
It's not just about the cost of the panels or the turbines. It's about the entire ecosystem needed to support them.
Precisely. And third, there are geopolitical and economic risks associated with the supply chains for renewable energy technologies, particularly solar panels and wind turbines. Many of the key components are sourced from countries with questionable labor practices or environmental records.
So similar to your concerns about electric vehicles, you're also highlighting potential vulnerabilities in the renewable energy supply chain.
Exactly. Now, I'm not saying that renewable energy is a bad idea or that it won't play a significant role in the future energy mix.
But you're betting that the transition will be more complex, more expensive, and take longer than many anticipate.
Exactly. And that during this transition period, traditional energy companies like EOG, with their focus on operational efficiency, cost control, and a balanced portfolio of oil and gas assets, could actually benefit.
It's a contrarian play, no doubt, but one that could generate significant returns if those assumptions play out.
That's the beauty of our This Is Not Financial Advice segment. We explore the unorthodox, the unconventional, the ideas that challenge the status quo.
And that's what makes it so much fun. All right, folks, we've reached the end of our deep dive into EOG Resources. We've covered their impressive performance, their strategic investments, their global ambitions, and even their commitment to sustainability. We've dissected their earnings call, analyzed their financials, and explored some wild trade ideas. Now it's your turn to weigh in. What are your thoughts on EOG? Do you share our optimism? What questions do you still have? Join the conversation in the comments below, and let's continue learning together. Until next time, keep diving deep, and stay tuned for more earnings call insights from Talk Tickers.